Good afternoon, Prashanth.
Good afternoon, Srini. Great to see you in person. This is something we have not done for a while.
For a while now, I know, but looks like the world is heading back to...
Yeah, fingers crossed.
Fingers crossed, absolutely. A quick introduction about Prashanth. He doesn't need much of an introduction. One of the faces of the startup ecosystem in India, built amongst the best known venture capital funds in India. Was a tech entrepreneur before becoming a VC, built successful companies there as well. I mean, I don't need to say too much about Prashanth since he's so well known in this market and this ecosystem. Quickly, Prashanth, last 2 years, you've seen a lot of action in your space, both in terms of investments and exits. You think this trend is going to continue? Do you see some bumps? Do you see the bumps being bigger or smaller?
The building blocks have kind of come together very well, Srini. Just the quantum of entrepreneurship, as in the number of quality entrepreneurs wanting to be part of this big opportunity. The digitization-led scale where users are more easily accessible and you can get bigger and bigger pools of users in shorter and shorter time frames. Monetary easing globally and the supply of that. And finally, some good early signs on exits. I think all these bode well. That's the bottom line. But there will be some corrections. We're already starting to see a little bit of that monetary easing tighten. I think and also see, none of these current entrepreneurs or even some of us as investors, we have seen at least a couple cycles. They have not seen a cycle.
True.
So how will they really respond to some of this? How will they really embrace this challenge and kind of come out stronger on the other end is something that I'll be more keen on seeing. And that, because I think ultimately businesses are 15 to 20 year marathons, right? Enduring businesses. I mean, every business today that gets that huge multiple, whether it's in the US stock or Indian stock, is because they've been able to be consistently doing what they're doing for 15, 20 years. So a lot of our entrepreneurs have to recognize that we are just in the very early stages of being able to demonstrate what we have built.
The truth is some will learn, Prashanth, and some will do well. Some will not learn and that's just the nature of the game.
Yeah.
That's just the nature of the game, I guess.
Right.
Now, quickly jumping into today's topic, which is ESOPs. ESOPs first became popular in India in the 90s when a lot of the IT services companies created a bunch of millionaires.
Right.
And then they suddenly disappeared. I mean, options were being granted, companies were creating option plans, making grants, but nobody really valued options. Suddenly in the last 3-4 years, options have become extremely valuable again. People are interested in options. People are interested in receiving grants as a key wealth creation tool. What has changed suddenly in the last 3-4 years?
So Srini, the original startups, like you said, were the Infosys of the world, the folks who really pioneered this idea of ESOPs. And then you had this little bit of a lull or a hiatus in entrepreneurship in the country. There was this period between roughly between 1996-97, almost a decade, and 2007-8 when Flipkart became the first company that started this new era, so to speak. In this period, there was not a lot happening in terms of new. I think we knew how to take advantage of our labor arbitrage, but I think as a country we did not know how to create value for ourselves. Value within by taking advantage of the consumer
in this ecosystem.
So Flipkart was the starting company that really showed how there's a new consumer behavior, there's a new consumer engagement model and a new business model led by being online first and so on. So I think it was the lack of startups where
more than anything else.
Yeah.
And I guess the other things which have happened is there's lots of liquidity in the market. Buybacks have happened.
I mean, that's because it's a byproduct, right?
Yeah,
Once
there are
people
valuable
see
companies.
valuable companies, more but I think this is something that we I think miss recognizing in India. Truly, the only country which has talent which is ready for the next 2 decades globally is our country, and there is no other parameter or metric that investors use to where they should put their future in. So, irrespective of whether we in India build for India or build for rest of the world, I think money is going to come here.
Okay, so I mean there will just be short periods when valuation corrections will be there.
Exactly.
Things will slow
Because
down.
talent is not going away.
Yeah.
Right? And that critical mass of talent does not exist in Europe, it does not exist in South America, and does not exist in Southeast Asia or in Japan. So where else?
So it's
And
only
of course,
China and India.
China, and we are of course English speaking, and all those other advantages.
Advantages are there.
And that's been another very interesting phenomena for the last 2-3 years, right? Why there has been this additional capital movement, this recognition that India is that China +1, and this +1, there is no other +1.
And China has become mature. China has got its own ecosystem now.
Correct.
External money has
Correct.
not as much value to add,
Correct.
so to speak.
Correct.
Whereas India can still, I mean, the capital can get benefit in India.
And globally fungible manufacturing is very different from globally fungible talent, right?
Yeah, talent
So
can move a lot more easily.
Talent can move across borders. Talent can be more collaborated with. You can't collaborate so much with manufacturing
facilities.
right? You can take advantage of that. You can leverage that. But talent, I think, builds a very different kind of ecosystem from a scale perspective.
Absolutely. So when we look at ESOPs, traditionally what we've done is simple 4-year vesting cycles with 25% each year,
Right.
1-year cliff.
Right.
In India, 1-year cliff is the law, but globally it's also the norm to have a 1-year cliff. It's taking much longer to build companies now. Is it time to rethink the vesting schedules? Should we make it longer to make it more commensurate with the time it takes to build a company now, or would you stick with this?
I think we'll largely stick with it, Srini. What we would probably do is tranche it a bit more. So there will be a better kind of graded contract where both parties will say, you know what, this is what we can see as, my value at this point in time. But as I become more important for the company, or as the company recognizes my value, there should be top-ups. So I think more sequential grants, tranched grants, I think will become the way they'll solve this problem, because it's very difficult for people to get comfort. I mean, I think people are not used to seeing their lives 5-6 years ahead, so they don't want to be so forward looking, because they then look at that as being tied to that company unnecessarily.
Every 4 years or every 5 years, you'll see,
incremental
grants being topped up and new grants being made.
We're already starting to see that. So for people who have, matured their contribution, their position in the company, I think the board, the leadership is very open to
Making new
recognizing
grants.
that, they definitely have value for the next 4-5 years.
Staying on the topic of vesting, we've seen simple time-based vesting all along.
Right.
When it comes to salaries and bonuses, there is no one-size-fits-all.
Right.
It is hugely customized. Bonuses are linked to individual performance, or at top management level, company level performance itself. We don't see that at all in stock vesting. Do you think companies should start looking at different parameters for vesting, especially at the top management level, linking it to individual performance, linking it to events at the company level? For instance, company achieving a revenue rate, achieving a valuation.
Yeah, I think, Srini, that's an interesting one that we keep kind of discussing. Individual performance-based grants kind of don't build necessarily the right culture.
Culture.
Right? So from a culture perspective, I would say company-based timing and events timed at the company level, going IPO, hitting a certain revenue or a profit number, and everybody then works towards that goal. And I think there can be, I think a lot of bonus top-ups also in the form of
Additional grants.
Additional grants is
If
another
this condition
way,
is
if this
met.
condition is met, is another way to solve
Look
that,
at it.
right? So why should all bonuses be cash, right?
Yeah.
Why can't bonuses be top-ups?
No, in fact, we are starting to see some employees saying we don't want a salary at all.
Right.
Treat our salary as an investment into the company and give us stock options instead. Especially if I'm a mid-30s person, I have a reasonable amount of wealth.
Right.
At least I can afford to not make a salary for 3-4 years. So when employees are willing to invest into the company in that way.
Correct. And Srini, this is a very interesting situation we saw during COVID. Companies had to downsize, right? They had to control cash, burn. And I was very encouraged, not in one company, across our companies, people were willing to trade cash
For ESOPs.
ESOP and actually ride that tough period really as
As a group.
no, and as true investors. I mean, as they're
staying in it for the long run.
Yeah, true shareholders of the company. Right? So there was this alignment and the flexibility that ESOPs and this options gave as a tool for that alignment. I can't think of any other way that this could have been done. So I think it's and I think you need some of these kinds of events also to feel people. You see people getting comfortable with it, and now some of these companies are bounced back, and they suddenly see that what they traded for is valuable 5 times because they just stuck in there and put their skin in the game. So I think this is a very interesting byproduct of what companies had to go through during this pandemic.
Yeah, and I guess that necessarily means that we have to think through the way we do these option structures a lot more.
Correct, and leverage it for various situations.
Now, and again, when you think of event-linked vesting, let's say a company is driving towards revenue targets, but suddenly decides to change it to profitability.
Right.
At that time, I guess we need to sit and spend time and see what impact it has on options.
Correct.
Talk through with our
and be
management.
willing to be flexible on some of these.
Yeah.
So I think as far as they know that options align everybody, and we would be fair on that alignment, I think the rest can be worked out.
So I guess the key is to make sure that we link it with the way the company is performing.
Yeah.
So that there's no misalignment between the option plans and the option grants and the company goals.
So and also link it to your changing role
in the company,
where it is not going to be static. Some people are going to perform better and be more valuable for the company over time. So you need to constantly recognize that and relatively readjust some of it. I mean, so I think that's going to be very key.
So one of my favorite books is this book called Who Says Elephants Can't Dance by Lou Gasna.
Yeah.
One of the things he says is at the lower levels, your incentives should be linked purely to individual performance, and as you grow in the ladder, it should be completely linked to company performance. It doesn't matter if I have done well.
Yes.
If the team has failed, I have failed.
Right.
So this event-linked vesting as opposed to individual performance-linked vesting plays directly into this philosophy.
Correct. And also, you want people to think long-term, Srini, at that senior level. The why Lou Gasna says that is, at the lower levels, the thinking is on what can I contribute today and what can I, what is my stuff doing today. Whereas at the next level, you are meant to be a bit more strategic. You are meant to say that, the decision I'm making today should make sense 2 years down the road.
2 years, 3 years, 4 years, whatever.
3 years, 4 years down the road. So you need people to have those horizons in mind when they make those decisions. And I think that's why options that way, no bonus, no salary increment ever aligns you towards that kind of long term.
Long-term
right?
thinking as,
because you know that if your option has to be valuable 3 years down the road, the decision that you're making today
has to be
has to bear fruit
3 years from now.
and be massively impactful for the company 3-4 years down the road. So this is a very good topic that there is this very subtle behavioral influential element that options play in how people think long term, that long term in terms of the decisions they make, not long term. See, one is, am I going to make money long term? I'm going to take options. That's one. But aligning that then to everything that you do,
the company culture, company long-term outcomes.
Like you said, group by these other kinds of top-ups and performance-linked thing for the company as a whole, will just make everything else
come together
very
So
well.
I guess simply put, at a lower level, you just link it to individual performance,
Right.
time-based vesting, don't think too much about it.
Correct.
At the more senior level, start playing around with some of these things. Do some top-ups, make sure that they are incentivized by standard grants,
Yeah.
but a big part of their grants is more outcome-driven.
Correct.
And at a company outcome level, not as opposed to an individual outcome level.
Right.
So when you think of options, there are really 2-3 levers. One is the strike price, one is exercise windows, and third is vesting. I just want to talk a little about exercise. In the West, it is very normal for employees to be permitted to exercise options, but for whatever reason, in India, the trend has been to not allow employees to exercise, except when there's a liquidity event. If there's an IPO, it's fine, but pre-IPO, you only allow exercise as part of a liquidity window. Do you think it's time to rethink that, find new structures where you get the balance between governance, control, voting rights, permitting employees to exercise, but through, say, trust structures, so that you still retain control of the company and you don't worry about a lot of other issues which come up, but employees get the benefit of...
So Srini, I think at a very high level, there has been a little bit of a trust issue, that if I have this odd shareholder on my cap table, and at the time of my exit, is this person going to cooperate? So I think that over a period of time, I think is changing. I think more and more people will get called out if they're unreasonable, and will be kind of singled out, so to speak. So I think that is at a very high level. But I think to get real comfort, you're right, some structures have to be built. And also I think some of our regulatory stuff, right, with respect to taxation, and some of that is also...
ultimately you end up paying taxes.
And
as employment income.
Correct.
If you don't exercise options at all.
Exactly.
Whereas if I sell it, I get one, the benefit of capital gain, so long as the period is correct.
Yes.
And second, I get to save on my taxes if I invest, say, into a house or invest into capital gains bonds.
So right now, the current regulatory taxation regime, right, is skewed towards not making that decision because I have a tax liability at the end of the day.
But I guess as companies grow, there will be structures where the company itself will find a way to fund the tax.
Correct. So that kind of funding, and like you said, new structures, trust structures, or any other structures where, I think there are some couple already in the works.
They're already in the works. We are seeing that being implemented also.
Right.
And from what I see, a lot of entrepreneurs are wanting to allow employees to exercise options.
Right.
At the end of the day, when you are a shareholder, even if it's via a trust, the connect is a lot more than if it's just an option.
True. And I think a lot of them want to build those long-term relationships. Right? I think it works well for them. They probably get more referrals if the person is still aligned. I mean, there is reasons to do that. I think my own sense is something will get created which will make this more amenable.
More amenable and more practical as well.
Yeah, practical over time.
So, like I was saying, the third lever is really strike price. What we see with most Indian companies is to have a simple par value strike price.
Right.
I mean, it's like literally making a grant of the value of the shares.
Because there is this notional value that I'm getting, Indians like things, it's not only, we like a real big value, right, that we are getting a big deal. So it just looks like you're getting a great deal when
you're at par value.
We're getting at par value. But
in,
I don't know if everybody does the math like you said.
yeah, so in late stage companies, would you recommend that you start doing discounts to fair value, but increase the you know the number of options you're granting, so that actually funnily, if I increase the number of options that if I get a higher number of options, but at a discount to fair value, I actually may make much more money
Yeah.
than a par value grant
Yeah.
if the company grows say 10x.
Correct.
And
Correct.
that 10x kind of growth in 2-3 years is just not unrealistic in today's.
Yeah. So I think I've seen right now, even in our companies, there is a mix. So there are few companies that are starting to do
Discount to fair value.
discount to fair value, and few companies that are doing some book value business, and there are few which are doing
Par value.
right? So there is a spectrum, but I'm seeing more companies experimenting with discount to
Fair value.
Fair value. So what is your own sense, Srini? I mean, you think?
See, actually, funnily, what I am seeing is some companies making grants where some to the same grantee, you have some at par, some at discount to fair value.
So that's because at the stage of the company. Right?
Stage of the company. These are late
Yeah.
stage companies.
Right.
Early stage, it doesn't make sense to
Early stage will be at par.
at par.
Right.
I mean, it makes no sense to do it anything
just
else.
because there's just not enough data, right? But I think a company that is at a series E, F, and some of
Even
that's-
Series D for that matter, Prashanth.
Yeah.
I mean, Series D or either
So basically
already a
companies
unicorn or
closer
very soon
closer
will
to
be a
being
unicorn.
Soon to be a unicorn. I think you will start seeing them.
The discount.
Correct.
So, in my own sense is, a discount to fair value is more fair both to the investors and to the employee, provided you increase the number of options you grant.
Srini, there's there's a side kind of comment here, element. It's a very good test of the belief of everybody in the value of the company. When you're taking it at discount.
A discount to fair value, absolutely.
Right? So
absolutely.
it's,
If you think I can grow 10x,
yeah,
then take the bet.
Take it, right? Otherwise, and a lot of ESOPs
Are at discount. It's
discount.
not. Yeah, it's not.
Exactly.
It's not at.
Correct. So I think the senior team. So maybe they will. I think there'll be more and more ESOPs that kind of come in at the senior level. I think will be
At discount to fair value.
Discount to fair value.
But the company will also have to put its foot forward and increase the number of options which are being granted.
Correct.
So that balance is there.
Exactly.
The balance is there. The last thing on the plan itself that I wanted to quickly chat up with you is, what is your sense of what is the right pool size at different levels?
So just to kind of some ballpark numbers, right? At seed, I think all of this post investment, seed would be about 15, Series A around 10, and open pool of about 5 to 7 at B and C. Right? And I think beyond that, I think a couple percentage points
being available at any given time.
Availability based on leadership, completeness of leadership, or
and you keep topping it up anyway. So
you keep topping it up. Srini, what do you see as planning? Are companies starting to think and more plan for ESOPs these days?
Definitely. I'm seeing more and more ESOPs for the reason that, unfortunately in a lot of startups what's happening is the early rounds there's a significant dilution that the founders are suffering, and the holding is, very often middle single digits per founder in late stage companies, which is fairly low, right, for somebody to stay committed for the next 5-7 years from that period. So we are starting to see more and more ESOPs, especially where founders have a low shareholding.
And is it on par with what you see in the West, or you think it's too early to say if we have more ESOPs here than in the US?
No, to be honest, I haven't really tracked how much ESOPs are there in the West, but in India, I definitely see this. I think part of the pressure you see on founders fighting for higher valuation in the beginning is because of the consequence of low holding at a later stage.
Sure.
But I think the mature investors, from what we are seeing, are being generous.
Be open to it, because most of these are linked to value.
Absolutely. And so long as you see value growth, you're fine with it.
Yeah.
In fact, in a couple of our companies, we are seeing compensation consultants being appointed to figure out what are the right grants to make. I mean, what Elon did
Yeah.
with his 10-year vesting cycle linked to
Right.
company performance,
Right.
has created a lot of interest, I guess.
So, do you see a more vibrant I mean, ESOP, this kind of compensation and consulting market being leveraged for ESOP or not much?
No, I think it will get leveraged a lot. What we are seeing action at multiple levels. One, we are seeing a secondary market fall in place for ESOPs. There are a lot of HNIs, a lot of family offices wanting to buy into ESOPs. We are seeing NBFCs ready to fund ESOP exercise.
Right.
We are seeing companies willing to, offer liquidity to employees. So the fact that the companies are offering liquidity is giving comfort to, institutional lenders to come
Yeah.
into that space.
Yeah.
So I
Yeah.
think the ESOP market is going to become extremely vibrant over the next 3 to 5 years. Not even next 3 to 5 years. I think we'll start seeing action very, very soon. It's already there, but it's not so much out in the public domain. But within a year,
So
year and a
it's an interesting phenomena if you see, I mean, if this happens, I don't know if it will really happen, that a lot of these family offices who run otherwise large businesses see what value ESOP is delivering in these businesses, and go
businesses.
back and kind of start
Implement it in their own
implementing
companies.
in their own companies.
No, that's definitely going to happen, Prashanth. It's definitely going to happen. In fact, a couple of close friends who are running businesses now, they are seeing the value of ESOPs in the startup ecosystem
And going back to
going
their
back
company.
and implementing it
Oh, so
there
it's
as
happening.
well.
Okay.
It's already happening. I can see that. I mean, at least wherever I guess people like you and me are involved, we are encouraging that also.
Correct.
And we are showing the power of
Yeah.
value creation.
True.
So, my favorite topic, look at the amount of liquidity we've had for ESOPs in the last year in India. Any general views on liquidity, Prashanth, for employees?
I think in a measured way, it is a good thing. I think people have a lifestyle and stage of life needs over time, and I think it's good for the company to be cognizant of that and not unnecessarily put them through. Especially when the company can actually enable it and make it happen.
And there is liquidity in the market.
And there's
today.
liquidity in the market. If a few people can take advantage of that,
Why not?
Why not? The second thing it creates is we are still early in our journey of leveraging options, and it creates more belief in a more compressed time frame, where people see that this is not something that's on paper. More and more people that I know, and not all companies. It takes time for companies to go IPO.
Yeah, it's taking much longer now.
It's taking longer, right? And although the great news is some of the IPO that have happened last year also are fueling some of the belief in the options.
ESOPs.
But I think it is more of this liquidity at the point of at the in between points that I think that companies are, and I think CEOs are being very careful about how they do it. So I'm seeing that,
Like you said, it should be measured.
it should be measured, and they are doing it in a very thought through manner. So I think it's good.
Good. See, and if I'm an employee of a listed company and I get a lower number of options, as soon as they vest, I can sell, I can cash them out.
Correct.
That it shouldn't become a disadvantage to join a startup.
Correct.
And therefore, this becomes.
So I think the rough time frame in my mind is the 4 or 5 year period, right? I think it's a good point on the average. I mean, there are a few companies which have given
Done it
people
earlier.
land where they want to earlier, but otherwise a 4 or 5 year period is a good time to give some partial liquidity to, and usually it's about 10 to 15% of the value. Right? And
which is reasonable.
And it could be more for the slightly the lower level folks, because they have just so relatively less options, and for people higher above, because they are much bigger option pools, it could be even smaller than 10%.
Yeah, even a smaller percentage will
make a
big difference. Yeah. So some crystal gazing, Prashanth, around options. What do you think is going to happen in the near term, in the medium term? Do you think it'll be more vibrant? It'll get more exciting?
Srini, let me have you answer this first, and then I'll add.
Okay. I mean, looking at the action at the ground level, I think options are going to be extremely valuable. There are some reports about the value of options that will be given out in the next 10 years, running into billions and billions of dollars in the US. The number can't be significantly smaller in India. Let's say we have 300 unicorns 3 years from now, and 10% is and let's say the average value of each unicorn is 2 billion, just for want of a better number. That means you have 600 billion in market cap in these 300 companies. And that I think is an underestimation, but just let's go with it for calculating numbers. 10% of that is option pool. That's $60 billion in options. That's a massive market.
So I wanted to add to that and bring in an interesting angle of how in the Web3 world, people get even more vested in this whole tokenized
Absolutely.
ecosystem, and everybody is part of the
growth.
company and the growth in a more embedded fashion. If that kind of embedded sharing of value is going to become more the norm, then my prediction is that options, the concept of options will hold 10x the significance in that kind of a world
Than it is today.
Than it is today.
And that makes it all the more important for us to think through how we do it and not just follow a cookie cutter.
And Srini, that also means that the way your business is and the way you're thinking of this whole option world may have to now
be recalibrated.
Recalibrated in this new.
No, we are actually spending a lot of time thinking about how it should be done.
Right.
In fact, the way we are thinking of automation, options should be as customizable as salary and bonus, so that people don't have to waste too much time on it. But at the same, you don't want to waste time on it. You want to spend time productively on it.
Right.
That's what automation should do. That's the way we think about options. So last question, Prashanth. Any specific advice to entrepreneurs and employees when they look at options?
Just being through 2 startups myself and now 30 odd investments, I think there's no better way to build wealth, right? So, of course, you should have belief in the company and the leadership. That said, there is no better way to align your contributions and get value for that in the long run than this tool, right? And liquidity being where it is today, and my own belief, we spoke about that in the very beginning, that there will be reasonable liquidity even for the foreseeable future. Of course, there will be ups and downs. I think it's a better tool than you investing in an unknown company.
Yeah, and investing in the public markets.
Public market.
And I guess the key is what you said at the beginning. Think through it, calibrate it, be measured in the way you do it.
Right.
Don't follow a cookie cutter model at all.
Yeah, that's important for the leadership and the people who are deciding on how. And for you, I think you need to, I think now recalibrate risk taking, given how the ecosystem has changed. And you don't have to be, I mean, we're no longer in a world where, the exit environment is unknown and liquidity is a problem. So I think those are behind us largely. So it's a great time for them to truly assess what to trade off. And I think that trade-off thinking is something that each of these folks should spend time on, and I don't know if they do enough thinking on that. And Srini, I think companies like yours can help educate them better to make those decisions.
Thank you so much, Prashanth.
Thank you.
Lovely discussion. Hope to engage with you more on topics like this.
Really enjoyed it, Srini.
Thank you.
Thanks.